All right, let's dive right into this explainer and crack open the toolkit of how financial professionals actually price assets out in the real world. If you've ever found yourself wondering exactly how analysts look at a stock and confidently declare it cheap or expensive, well, you are in the perfect place. We're going to break down the mechanics of relative valuation step by step. We're actually going to start with a pretty fundamental philosophical dilemma of investing, and it's perfectly captured by Oscar Wilde. A cynic knows the price of everything but the value of nothing. You see, recognizing that price and value are not always the same thing is really step one here. Out in the financial markets, there's a surprising number of investors who subscribe to what's known as the bigger fool theory. They essentially argue that the intrinsic value of an asset doesn't actually matter as long as there is a bigger fool out there willing to buy it from them at a higher price later. But obviously, sound investing dictates that you shouldn't pay more for an asset than what it's truly worth.
So that brings us to the ultimate question every investor faces when they're looking at a stock, a bond, or even a piece of real estate. How do we actually determine what a financial asset is worth? I mean, we don't buy financial assets for aesthetic reasons, like a beautiful painting or a sculpture, right? We buy them for the cash flows they're expected to generate. So our perception of value has to be backed up by reality.
To help solve this valuation puzzle, here is our roadmap for this explainer. We'll briefly cover 1. The asset pricing dilemma, 2. What is relative valuation, 3. Understanding financial multiples, 4. Finding truly comparable firms, and finally, 5. The pitfalls of relative valuation. Let's kick things off with Section 1, the asset pricing dilemma, value versus price. Our explainer today is grounded in the absolute gold standard text on the subject by acclaimed NYU finance professor Aswath Damodaran, and his work reminds us of a really critical, maybe even slightly terrifying rule. Models don't value companies. You do. Valuation isn't some pure hard science. It is heavily influenced by the inputs we choose and the subjective judgments we make along the way.
And this split right here brilliantly illustrates the philosophical divide in investing. Do you trust the fundamentals, or do you trust the wisdom of the crowd? Intrinsic valuation, like your classic DCF models, assumes the entire market can make massive mistakes across whole sectors, and you're essentially trying to find the true intrinsic value based on future cash flows. Relative valuation, on the other hand, is built on a very different premise. It assumes the market is generally correct on average, but it might make little errors in pricing individual specific stocks. Moving right along to Section 2. What is relative valuation, the real estate approach? The easiest way to think of this is like buying a house. You don't typically sit there and calculate the discounted future cash flows of living in a 3-bedroom suburban home, right? No way. You just look at what similar homes in the exact same neighborhood sold for recently. If 3 basically identical houses down your street sold for $500,000, you're going to assume your house is worth roughly $500,000. In relative valuation, we're taking this exact same logic and applying it to stocks and businesses. To actually do this for financial assets, Damodaran outlines 2 highly practical steps we need to execute. Step 1, standardize prices into multiples, and Step 2, find similar, comparable firms. Let's break down exactly how we calculate this. Which brings us to Section 3, understanding financial multiples, standardizing prices. Now, because you can't just compare the raw share price of a giant mega corporation with billions of shares outstanding to some tiny startup with just a few million shares, we use a multiple to put them on a level playing field. Think about it. If you look at a $100 stock and a $10 stock, the $10 stock isn't automatically cheaper. Instead, we calculate a multiple. If that $100 stock generates $10 in earnings per share, you literally just divide the price by the earnings. You are paying 10 times earnings, a PE of 10. Boom, this levels the playing field instantly. Now, this is where it gets really interesting. Behind every multiple is a single logical driving force, what Damodaran calls a companion variable. Every single multiple is ultimately determined by risk, growth, and cash flow potential. For the price to earnings or PE ratio, the absolute key driver is the expected growth rate in earnings per share. If 2 companies have the exact same risk, the one growing faster should logically trade at a higher PE multiple, right? For the price-to-book value ratio, the core driver is return on equity. And for the price-to-sales ratio, it's the net margin. If you ignore expected growth, you might look at a stock with a PE of 8 and think it's an absolute steal compared to one with a PE of 12. But actually, that cheaper stock might just be a dying business. Okay, Section 4, finding truly comparable firms, the search for peers. Since no two firms on Earth are exactly identical, we have to accept some differences and figure out how to mathematically or subjectively control for them. In an ideal world, finding a comparable firm doesn't just mean looking at a company in the same industry. A software firm could actually be compared to a telecommunications firm if they happen to share the exact same risk profile, growth rate, and cash flow generating potential. But let's be real, finding that perfect clone is basically impossible in the real world. Because we can't find those perfect clones, analysts use a variety of techniques to adjust for the discrepancies. Sometimes it's a subjective adjustment, like noting your firm has a higher PE than the industry average, but deciding it's totally justified because it has less debt and better management. Or you can mathematically modify the multiple. A fantastic example of this is the PEG ratio, where you literally divide the PE ratio by the company's expected growth rate. It brilliantly levels the playing field for companies that are scaling at wildly different speeds. Finally, for a much wider lens, you can actually run statistical regressions across the whole market to control for variables like risk and payout all at the same time. Finally, we arrive at Section 5, Pitfalls of Relative Valuation, the dark side of multiples. The sheer simplicity of relative valuation, that's also its Achilles heel. First off, you absolutely have to ensure uniformity. If you're using trailing earnings for one company, you cannot use projected future earnings for another. Otherwise, the comparison is completely meaningless. Second, because relative valuation measures current market mood rather than intrinsic value, it can easily lead you to overvalue assets if the entire market is currently caught up in a euphoric bubble. And finally, unlike DCF models where all your assumptions are explicitly laid out right there in a spreadsheet, the assumptions in relative valuation are very often hidden. And here is the really dangerous part. Relative valuation is so easily manipulated to tell whatever story an analyst wants you to hear. If an analyst really wants to justify a sky-high price for a mediocre tech startup, they literally just have to cherry-pick a group of wildly overvalued darlings and call them comparables. By carefully choosing the right multiple and the right peers, you can essentially reverse engineer any valuation you want. So, as we wrap up this explainer, I want to leave you with this final thought. Relative valuation is a fantastic, highly practical tool for gauging market pricing, but it relies entirely on the assumption that the market is right on average. Next time someone pitches you a stock because its PE ratio looks cheap compared to its peers, ask yourself, is the stock actually a bargain, or are you just buying the cheapest house in a wildly overpriced neighborhood? Thanks for joining me on this explainer, and always keep questioning the value behind the price.